I know that the title sounds dramatic to this video, but it's the only way I could think of to get you to pay attention to what I believe is one of the most important financial decisions you'll ever make. In fact, don't take my word for it. According to the ONS here in the UK, 42% of all household wealth is inside of these things. And just for some perspective, it's worth more than property wealth in total, yet only about 1 in 4 people can tell you what it's actually invested in. Now, you might have guessed it by now, but I'm talking about pensions, and in this video, I want to explain everything you need to know about them, keeping it as simple as possible. So let's start from the beginning and explain what a pension is and how it works. The idea of a pension is that you save money every time you get paid, and that money gets invested for you, and then when you come to retire, that pot of money can be used to pay for your living costs when you're not working. Here in the UK, if you're employed, then you almost certainly have a pension. Also, since 2019, new legislation means that you are automatically enrolled into a pension if you are an employee of a company aged at least 22 years old and earn over £10,000. It is worth saying that if you earn less or are aged between 18 and 21, you can still get into a pension, but you would have to ask your employer as it won't be automatic and they don't have to put money in from their side. Now, how do they work? Firstly, it's worth saying that there are 2 main types of pension. You have defined contribution and defined benefit. Defined benefit pensions are also known as final salary pensions and are commonly found in the public sector. They're a lot rarer than they used to be as they're very expensive to manage, and as the name suggests, they will pay you a fixed amount of money in retirement. These are very valuable as it doesn't matter what happens with the stock market or with the economy, you'll get paid based on your average total career earnings. A good example of a defined benefit pension would be the NHS pension. If you start working for the NHS now or you already work for the NHS, you'll likely be part of their defined benefit scheme. Now, the second type of pension, which is a lot more common, is known as a defined contribution scheme. As the name suggests here, the only guarantee is the amount of money that you and your employer put in. I think it's always worth finding out what type of scheme you're in right now. Just ask your employer to find out. Now, here's where the fun begins and we get to talk about money. So defined benefit pensions are going to be different here as this will vary. You'll probably be paying a lot more every time you get paid into these schemes, but when we look at defined contribution pensions, here is what you need to know. As a bare minimum, when you get paid, the amounts that go into your pension will look like this. You will pay 5%, your employer will pay 3%. Also, it's worth saying here that of your 5% contribution, 1% of that will be from tax relief, meaning that you would have put in just 4%. In cash terms, here's what that might look like. Say you want to contribute £100 into your pension each month. In order to get a £100 contribution, you will only need to put in £80. £20 will then be from tax relief as a basic rate taxpayer, and then your employer will contribute their 3%, which in this example would be £60. So in total, you'd get £160 into your pension, and the best part is that this has only cost you £80 as the rest is made up from your employer and tax relief. I think this part is really worth stressing, but there is nowhere in the investing world where you can put in £80 and get £80 added on immediately. And this is literally doubling your money. Now, this is where pensions are so powerful because now that you've got all of that tax relief and free money from your employer, that money will then get invested over a really long time frame. And the more money you put in, the bigger those compounding effects will be in the long run. Now, there's no guarantees what will happen in the future. That is always important to remember, but over the long run, you're likely to do pretty well. So I hope that part is really clear. I did also want to say here that if anyone chooses to opt out of your company pension scheme, you are going to lose that free contribution from your employer. And quite frankly, I think that would be an extremely foolish thing to do. Now, I'm obviously not your financial advisor, nor do I claim to be one, but I think opting out of a workplace pension in the long run would be a very, very foolish thing to do. You might have some more cash in your pocket at the end of the month, but you'd lose out on everything that I've just shown here. Higher and additional rate taxpayers can also get even more benefits, but more on that part a bit later. Okay, another thing I wanted to add here as well was to say that this 8% contribution into your pension is just the legal minimum. And there are a lot of employers out there who will put in more into your pension if you also increase your contribution. This, in my view, is a no-brainer if you're able to afford it, as yet again, it's free money and it's almost like making 100% on your investment as soon as you pay money into your pension. Now, every employer will be different here, so you're going to need to check with them what their policy is. Depending on the size of your company, this could be a question for HR, payroll, or you might even have this outsourced. Either way, I really do think it's worth everybody understanding what the policy is and how their company pensions work. Remember, your pension is likely to be either your most valuable asset or your second biggest asset alongside your house. So I really do think it's worth taking a little bit of time to learn about it. Right, next step. Now that you know how the pension works, we need to discuss what happens to this money and where it ends up. Here's where I think most people lose track of things and where some of the big issues begin to pile up. As I mentioned at the beginning, according to a recent survey by the Pensions and Lifetime Savings Association, only 1 in 4 people say they know what their pension is invested in. And almost 70% of people say that they lack or do not have the skills needed to choose where to invest their pension, leaving it to the hands of the providers. I personally think we can all do a lot better here, and I genuinely think that most people can get to the grips with the basics. You just have to take a little bit of time to learn them. Anyway, your money ends up with a pension provider that your company has selected to manage their pension plan for them. For most companies, this could be one of the big players like Legal & General, Scottish Widows, Aegon, Aviva, and so on. Once you're set up with your pension, you should receive some kind of communication from the providers. It could be a letter, an email, or even both, letting you know all of the details and what you can do next. Now, here's where most people don't take any action, and what this means is that your money ends up getting invested into a default fund. The default fund will vary from provider to provider, but basically this will be a mix of stocks and bonds that the provider has put together to try and suit the majority of people. The biggest issue here is that the providers have had to make a default option to try and suit most people, and by doing that, they end up giving an investment that could be a bad fit for you, depending on where you are in your investing journey. And this could be a whole video in itself, but the default option is also likely to come with a lot more fees than you could have got if you just make a few little changes. For example, in a call I had recently on a one-to-one, we looked into what was in their pension as they wanted to get a bit of a second opinion to help make sense of it all. They were in a default pension fund from one of the major pension providers, and this meant that their money was split between several funds. 2 of them were a mix of stocks and bonds, and then the other was a short-term cash fund. Now, this person is still more than a decade away from retirement, and they had been investing in this pension for years and put a lot of money in, doing all the right things as everyone tells you to do. The issue was that this mix of fund was, in my view at least, just way too cautious and didn't take enough risk to allow for growth. For some perspective, if you were to invest £200 a month into your pension and keep it inside a default fund, you could end up with a lot less than you expected over the years when you compare that to someone who invested a little differently. I've run a quick calculation, and from January 2015 until today in 2024, a default pension fund would have got you a return of around £38,000, assuming it was a mix of 60% stocks and 40% bonds. Now, compare that to investing in 100% stocks, and you could have returned £48,500 during the same time frame. That's a return of 27% more by picking 100% stocks if you were happy with that level of risk. Now, obviously, the most recent stock market performance has been really good overall, and nobody knows the future or can tell you what level of risk that you should take with your investing choices, but I did think it was worth knowing what the default option was, and it's going to lean heavily towards a cautious investor. Clearly, they have to do this to suit the most amount of people, but it is your right and your choice to make that decision and decide where your money is invested. Letting someone else choose for you where your money is in your pension is like letting someone else decide for you what house you're allowed to buy and where you can live. I don't think you'd accept that with a house, so why do it with a pension? If you take anything away from this part of the video, I personally think that it's worth digging out that last letter you got from your pension provider or logging onto your account and really figuring out what you're invested in. Then see what other choices you have available to you from the provider and maybe try and choose something that suits you better. I appreciate this will be daunting for a lot of people, so before you do that part, you might want to check out a lot more videos on my channel that will help you break down what kinds of things you should look for when choosing funds and generally around investing. You can usually find out all of this information from the website of your provider, or you can call them as well. If you want me to do a follow-up video on this part, let me know and I can help explain in a bit more detail how to look for funds for your pension. If you make sure you hit the like button for me and comment below, then this will give me the message that this is what you want. But for now, on to some more of the details. Okay, a quick section now just to let you know that if you're a higher rate or an additional rate taxpayer, meaning that you earn more than £50,270 a year, pensions can be one of your best friends. Basically, once you enter these higher tax brackets, you can claim back additional tax relief. This diagram from Penfold is a good way to explain it. On the left, you can see what a basic rate taxpayer gets in terms of tax relief when they pay into a pension, like we talked about earlier. If you pay in £100, then you get £25 worth of tax relief. Now, if you earn in the higher tax brackets, you can claim back 20% or 25% of additional tax relief for any money that you put into your pension, so long as you've earned enough money inside that tax bracket to cover the contribution. So, for example, if you make £56,000 a year and you want to put in £5,000 into your pension, you'll first automatically get the 20% tax relief applied inside your pension account. Then, through a self-assessment tax return, you can get an additional tax relief that would be refunded to you, which would essentially mean that you'd get £1,250 back in your pocket in this example. The same rules apply to additional rate taxpayers, as you can see, and you can get back even more. There's a sweet spot, as you can see, if you're in this zone between 100k and 125k because of the way that you lose your tax-free allowance, so make the most of that. A pension contribution will be one of the best things you can do with your money. Now, just a final note on this part, please note that you can only claim additional tax back if your pension type is a relief at source. If your work pension is one that uses the net pay method, then this tax relief is already factored in and your pension contribution is taken before all taxes in your payslip. The only way to know what type of pension you have is to check with your employer or ask the provider. So ask them that question just to make sure. As always, you can see how complicated pensions can get, and I can't cover all of the details here. Okay, so what about any limits? How much can you put in each year into your pension? Here's the basics that you need to know. Each tax year, you can currently put in £60,000 in total. This amount includes the tax relief. So this means that from your pocket, you can contribute £48,000 and then you'd get a top up and get that lovely £60,000 amount. Just also be aware, I will mention this later, that amount also includes contributions from your employer too. Again, you can see how this thing gets complicated. Now, as always, there's more detail, and the key thing you need to know here is that the maximum you can put in is up to 100% of your income for that tax year. This means that unless you're making £60,000 a year, you can't put in £60,000. That might sound obvious, and you might think, how can you put in more money than you make anyway? But of course, you could have money from loads of other places compared to your income. For example, you could get an inheritance, sell a property, for example, or even sell shares. This limit stops people from just putting in a huge sum of money and getting a huge tax break. Now, another little detail here is that you can actually go back and put more money into your pension, as there is a carry forward rule. I'll show you on screen what that looks like, but basically, if you max out this tax year, you can go back and contribute to previous tax years. Now, as you can see, the limit wasn't always £60,000. It did used to be £40,000. So in theory, the maximum you can put in for the past 4 years, including this one, would be £200,000. Not too shabby if you've got the money. If you want to see all of the limits and allowance rules on pensions, I'm going to leave a link in the description from the government website, as this has all of the other details. There's just way too many to go through, and I don't think this is a good time to just go through all of them. Just remember that these limits apply to all of your pension contributions, including what your employer puts in as well. So be careful if you're trying to make that calculation. If you have this amount of money, it might be worth speaking to an accountant or a financial advisor just to make sure you get this done correctly. And I am neither one of those things. Hopefully you see the point. The pension is such a powerful tool, and it's even better if you have some more money to put away, because the tax benefits are huge. Right, what about if you're self-employed or run your own business? Can you still get a pension? The answer is absolutely yes. And you can do this in a few different ways. Firstly, there are schemes you can sign up to as a business owner. And secondly, you can create your own personal pension, which is called a SIP. This stands for Self-Invested Personal Pension. And it's a type of account that will allow you to invest your pension in whatever you choose. Some, not all providers, will let you set up your SIP so that you can contribute directly from your business bank account. This is personally what I have set up at the moment, and I'm currently contributing directly from my business into my pension each month. The main benefit here is that pension contributions are an allowable business expense, so this helps reduce your corporation tax bill. As always, there's a ton of details about how much you can put into your pension as a business owner. The limits still apply, and you should speak with an accountant or a professional if you're not sure. Also, anyone can open a SIP, and there is no limit to the number of accounts that you can have. If you have a workplace pension already, you are free to open a SIP on the side and contribute into it. This applies regardless of whether you own a business or you're self-employed. I personally have 2 SIP accounts set up, one I'm contributing to from my business, and one I'm putting in personal contributions. Now, on the subject of SIPs, this could be an entire video, but I did want to say this quickly, that if you have old pensions lying around from previous employers, you are free to move them wherever you like. You might not even know these exist, or you might have lost track of them. There are estimates out there that tens of billions of pounds are sat around in lost pots, and over 1 million accounts are not doing anything. This could happen for a number of reasons, but maybe you've moved house and forgot to inform the provider, and all that they're doing is sending letters to an old address. Now, thankfully, you can track down your pensions using a free government tracing tool. Don't be fooled into using some paid-for service. There are a lot out there trying to scam people. I think you're all capable of doing this. You'll just need basic information like who your employer was, the dates you worked for them, and your previous address information. I moved all of my old workplace pensions into a single SIP, and it was a very smooth process. If you need to do this, all you need to do is open a new SIP and then give your new provider the details. Now, if you want a full video on this topic, again, please let me know, like the video, let me know in the comment section below so I can make it known that it's actually a priority for you. Okay, final point I wanted to highlight for all of you, probably one that you really want to know. When can you access your pension and get your hands on that lovely cash? Well, the rules right now state that you must be 55 if you want to be able to draw down money from your pension, and this will be rising to 57 by 2028. We should also assume that this age will keep increasing alongside the state pension age, but please always remember that rules can change at any point, so you need to keep an eye on this. Before that date, you can't access the money in your pension. Well, technically you can, but it will cost you a huge penalty. It's not like it's against the law or anything. Once you get access to your pension, there are multiple ways you can take the money out of it. Yet again, it can get complicated and there are loads of details here, but essentially, you can get 25% of it tax-free, and the rest will be taxed as income once you take it out. You can get pretty clever here once you need the money and save quite a lot on taxes if you draw down the money out in the right way. Also, it's worth saying that you don't suddenly stop investing when you reach retirement. Most people are still going to want to have their pension invested and in the market, but then just draw down what they need. At the end of the day, it's completely up to you what you want to do and will all depend on your own circumstances that you find yourself in. This page from the Money Helper website is quite good at explaining what options you have with your pensions, and I'll make sure to leave that one in the description below also as a link. Let me just leave you with one final thing to show you just how powerful a pension can be over investing lifetime. Let's say that instead of using a pension, you used another kind of investing account and you put in £200 a month into this. That £200 got no tax top-ups or no contribution from your employer. And over 30 years, it would have grown to £334,000. Sounds pretty good. Now, what about if you put £200 into a pension instead? Got your tax top-ups and employer contributions. This would mean that instead of £200 a month being invested, you would be investing £400 in total. £200 from you, £50 worth of basic tax relief, and then £150 from your employer, assuming it's just the minimum. As you might guess, double the money means double the returns. And you have £668,000 in the same 30 years. Don't sleep on your pensions and make sure you find out exactly what you can do with yours. I'll see you in the next video. Happy investing.